Hi, Warren and Charlie. My name is Vicky Wei. I'm an MBA student from the Wharton School of Business. This is my first time to be in the annual meeting. I'm really excited about it. Thanks for having us here.
Thanks for coming.
My question is, where do you want to go fishing for the next 3 to 5 years? Which sectors are you most bullish on, and which sectors are you most bearish on? Thank you.
Yeah, Charlie and I do not really discuss sectors much, nor do we let the macro environment or thoughts about it enter into our decision. We're really opportunistic, and we obviously are looking at all kinds of businesses all the time. I mean, it's a hobby with us almost, probably more with me than Charlie. But we're hoping we get a call, and we've got a bunch of filters, and I would say this is true of both of us. We probably know in the first 5 minutes or less whether something is likely to or has a reasonable chance of happening. And it's just going to go through there, and it's going to, the first question is can we really ever know enough about this to come to a decision? And that knocks out a whole bunch of things, and there's a few, and then if it makes it through there, there's a pretty good reasonable chance we may do something. But it's not sector specific. We do love the companies, obviously, with the moats around the product, where consumer behavior can be perhaps predicted further out. But I would say it's getting harder for us anyway, to anticipate consumer behavior than we might have thought 20 or 30 years ago. I think that's just a tougher game now. But we'll measure it, and we'll look at it in terms of returns on present capital, returns on prospective capital. A lot of people give you some signals as to what kind of people they are, even in talking in the first 5 minutes, and whether you're likely to actually have a satisfactory arrangement with them over time. So a lot of things go on fast, but we know the kind of sectors we kind of like to, or the type of business we kind of like to end up in, but we don't really say we're going to go after companies in this field or that field or another field. Charlie, you want to?
Yeah, some of our subsidiaries do little bolt-on acquisitions that make sense, and that's going on all the time. And of course we like it. But I would say the general field of buying whole companies, it's gotten very competitive. There's a huge industry of doing these leveraged buyouts. That's what I still call them. The people who do them think that's a kind of a bad marker, so they say they do private equity. It's like making a janitor call himself the chief of engineering or something. But anyway, the people who do the leveraged buyouts, they can finance practically anything in about a week or so through shadow banking, and they can pay very high prices and get very good terms and so on. So it's very, very hard to buy businesses, and we've done well because there's a certain small group of people that don't want to sell to private equity, and they love the business so much they don't want it just dressed up for resale.
We had a guy some years ago came to see me, and he was 61 at the time, and he said, "Look, I've got a fine business. I got all the money I can possibly need, but," he said, there's only one thing that worries me when I drive to work." Actually, there's more than one guy that's told me that's used the same term. He said, "There's only one thing that bothers me when I go to work. If something happens to me today, my wife's left. I've seen these cases where executives in the company try to buy them out cheap, or they sell to a competitor, and all the people." He says, "I don't want to leave her with a business. I want to decide where it goes, but I want to keep running it, and I love it." And he said, "I thought about selling it to a competitor, but if I sell it to a competitor, their CFO is going to become the CFO of the new company, and they're on down the line, and all these people who helped me build the business, a lot of them are going to get dumped, and I'll walk away with a ton of money, and some of them will lose their job. He said, I don't want to do that. And he says, I can sell it to a leveraged buyout firm who would prefer to call themselves private equity, but they're going to leverage it to the hilt, and they're going to resell it, and they're going to dress it up some. But in the end, it's not going to be in the same place. I don't know where it's going to go. He said, I don't want to do that. So he said, it isn't because you're so special. He says, there just isn't anyone else. If you're ever proposing to a potential spouse, don't use that line. I mean, but that's what he told me, and I took it well. And we made a deal. Logically, unless somebody has that attitude, we should lose in this market. I mean, you can borrow so much money so cheap, and we're looking at the money as pretty much all equity capital, and we're not competitive with somebody that's going to have a very significant portion of the purchase price carried in debt, maybe averaging 4% or something.
And he won't take the losses if it goes down. He gets part of the profit if it goes up.
Yeah, his calculus is just so different than ours, and he's got the money to make the deal. So if all you care about is getting the highest price for your business, we are not a good call. And we will get some calls in any event, and we can offer something that wouldn't call it unique, but it's unusual. The person that sold us that business and a couple of others that actually it's almost word for word the same thing they say. They are all happy with the sale they made, very happy, and they have lots and lots and lots of money, and they're doing what they love doing, which is still running the business, and they know that they made a decision that will leave their family and the people who work with them all their lives in the best possible position. And that's in their equation. They have done what's best, but that is not the equation of many people, and it certainly isn't the equation of somebody who buys it and borrows every dime they can with the idea of reselling it after they maybe dress up the accounting and do some other things. And but when the disparity gets so wide between what a heavily debt financed purchase will bring as against an equity type purchase, it gets to be tougher. There's just no question about it, and it'll stay that way.
But it's been tough for a long time, and we've bought some good businesses.
Yeah.
At what rate has Berkshire compounded intrinsic value over the last 10 years? And at what rate, including your explanation for it, please, do you think intrinsic value can be compounded over the next 10 years?
Yeah. Intrinsic value, can only be calculated or gains, in retrospect. But the intrinsic value, pure definition, would be the cash to be generated between now and Judgment Day, discounted at an interest rate that seems appropriate at the time, and that's varied enormously over a 30 or 40-year period. If you pick out 10 years and you're back to May of 2007, we had some unpleasant things coming up, but I would say that we've probably compounded at about 10%, and I think that's going to be tough to achieve, in fact, almost impossible to achieve if we continued in this interest rate environment. That's the number one question. If you ask me to give the answer to the question, if I could only pick one statistic to ask you about the future before I gave the answer, I would not ask you about GDP growth. I would not ask you about who was going to be president. A million things. I would ask you what the interest rate is going to be over the next 20 years on average, the 10-year or whatever you wanted to do. And if you assume our present interest rate structure is likely to be the average over 10 or 20 years, then I would say it'd be very difficult to get to 10%. On the other hand, if I were to pick with a whole range of probabilities on interest rates, I would say that rate might be, it might be somewhat aspirational, and it might be doable. And you would say, well, we can't continue these interest rates for a long time. I would ask you to look at Japan, where 25 years ago we couldn't see how their interest rates could be sustained, and we're still looking at the same thing. So I do not think it's easy to predict the course of interest rates at all. And unfortunately, predicting that is embedded in giving a good answer to you. I would say the chances of getting a terrible result in Berkshire are probably as low as about anything you can find. Chances of getting a sensational result are also about as low as anything you can find. So if my best guess would be in the 10% range, but that assumes somewhat higher interest rates, not dramatically higher, but somewhat higher interest rates in the next 10 or 20 years than we've experienced in the last 7 years. Charlie?
Well, there's no question about the fact that the future with our present size is, in terms of percentage rates of return, is going to be less glorious than our past. And we keep saying that, and now we're proving it.
Do you want to end on that note, Charlie, or would you care to?
Well, I do think Warren's right about one thing. I think we have a collection of businesses that, on average, has better investment values than, say, the S&P average. So I don't think you shareholders have a terrible problem.
And I would say we probably, well, I'm certain, we do have more of a shareholder orientation than the S&P 500 as a whole. I mean, this company has a culture where decisions are made as an owner, as a private owner would make them. And frankly, that's a luxury we have that many companies don't have. I mean, they're under pressures today sometimes to do things. One of the questions I asked the CEO of every public company that I meet is, what would you be doing differently if you owned it all yourself? And the answer, is usually this, that, and a couple of other things. If you would ask us, the answer is we're doing exactly what we would do if we owned them all the stock ourselves. And I think that's a small plus over time. Anything further, Charlie?
I think we have one other advantage. A lot of other people are trying to be brilliant, and we're just trying to stay rational. And it's a big advantage. Trying to be brilliant is dangerous, particularly when you're gambling.
What is the value of Berkshire to the world?
Yeah, well, I would say the question about I'm with him to the point where he says that, which he accurately describes as delegation to the point of abdication. But I would argue that abdication actually, in many cases, will enable those businesses to be run better than they would if they were part of the S&P 500 and the target perhaps of activists or somebody that wants to get some kind of a jiggle in the short term. So I think that our abdication actually has some very positive value on the companies. But that, you'd have to look at it company by company. That we've got probably 50 managers in attendance here, and naturally they're not going to say anything publicly on television or anything where they knock us or anything, but get them off in a private corner and just ask them whether they think their business can be run better with a management by abdication from Berkshire, but with also all the capital strengths of Berkshire, that when any project that makes sense can be funded in a moment without worrying whether the banks are still lending like in 2008, or whether Wall Street will applaud it or something of that sort. So I think our hands-off style actually, I think, can add significant value in many companies. But we do have managers here. You could ask about that. We certainly don't add the value by calling them up and saying that we've developed a better system, for turning out additives at Lubrizol or running Geico better than Tony Nicely can run it or anything of the sort. But we do we have a very objective view about capital allocation. We can free manage. I would say that we might very well free up at least 20% of the time of a CEO in the normal public, who would otherwise have a public company, just in terms of meeting with analysts and the calls and dealing with banks and all kinds of things that essentially we relieve them of. So that they can spend all of their time figuring out the best way to run their business. So I think we bring something to the party, even if we're just sitting there with our feet up on the desk. Charlie?
Yeah, we're trying to be a good example for the world. I don't think we'd be having these big shareholder meetings if there weren't a little bit of teaching ethos in Berkshire. And I've watched it closely for a long time. I'd argue that that's what we're trying to do, is set a proper example. Stay sane, be honest. Yeah. So I'm proud of Berkshire, and I don't worry too much if we sell Coca-Cola.
I would say, Geico is an extraordinarily well-run company, and it would be extraordinarily well-run if it were public. But it has gone from 2 and a fraction percent of the auto insurance market to 12%. And part of the reason, the small part, the real key is Geico and Tony Nicely, but part of the reason is that when at least 2 of our competitors, big competitors, said that they would not meet their profit objectives if they didn't lighten up their interest in new business 8 or 10 months ago, I think our business decision to step on the gas is a better business decision, but I think that Geico as a public company would have more trouble making that decision than they do when they're part of Geico, because we are thinking about nothing but where Geico is going to be in 5 or 10 years. And if that requires having we want new business costs to penalize our earnings in the short term, and other people have different pressures. I'm not arguing about how they behave, because they have a different constituency than Geico has with Berkshire and what Berkshire has with its shareholders in turn. And I think in that case our system's superior. But it's not because we work harder. Charlie and I don't do hardly anything.